I have one more session before lunch, and I am very pleased to participate in this one. It's a pleasure to welcome Larry Glassberg to the stage. Larry, thanks for being with us today.
Great to be here.
Larry co-heads the investment banking activities at Maxim Group, which is based here in New York. And as I'm sure many of you know, Maxim is very active and a leader in the kind of lower middle market emerging sectors, including shipping. And so it's great to have you here. Larry, can you give us just 1 minute on Maxim, just a quick?
Yeah, sure. Happy to do that. It's great to be back in Marine Money. I'm a New Yorker, so it's always great to see these events here in New York. Maxim is a full-service investment bank. We're 22 years in existence. We're typically doing about 150 to 200 transactions a year. We've been 1 or 2 in the league tables in virtually every sector that we've been banking over that time period. Sector-wise, healthcare, energy industrials, infrastructure, TMT, and maritime. In particular, in the maritime, I've been servicing the maritime sector for 20 years. I kind of joke I'm probably like the longest serving banker at the same firm in the maritime industry today. But all jokes aside, we've been very supportive to the capital markets for shipping, and we've been the most active in the maritime space over the last 5 years, probably tenfold than anyone else in the equity markets.
That's great. Yeah, no, you guys have done a lot of transactions. And last year, you were on a capital markets panel here on this stage, and there was a discussion on the subject of warrants that I would say was pretty robust, is how I would describe it. And I want to thank you for coming back to talk a little bit more about this topic, because, you know, after that panel, it sort of got me thinking about the topic and this idea of, you know, smaller companies raising equity. And it felt like an important topic for a couple reasons. One is that we have a lot of investors, many of whom are watching the live stream today, and many others in the audience who need capital to grow. These are very small businesses. In fact, a lot of the biggest companies today started coming to Marine Money when they had just a handful of ships. So we have investors and we have companies that are interested in accessing capital. And so this part of the market, kind of the smaller owners, it's an important part of our industry. And so I want to kind of talk a little bit more about that. Before we get into it, let's talk about size. Like, what is your idea of a small company? Because we know the whole sector is relatively small in the capital markets, but maybe you could talk a little bit more about that.
Yeah, before I go in, I just asked if the AV guys can throw up the presentation just so the audience can see some of the facts. But generally speaking, if we look at the public markets as a whole, there's roughly 5,000 companies that are listed on national exchanges in the United States. Of that 5,000, these are companies that are non-ETFs. Roughly 46.8% of those companies are below 500 million in market cap. An enormous amount of the public markets is below 500 million in market cap. In particular, over this time period, there was 1,900 equity financings. We recently put out a report from the Maxim side looking at all financings that were done in the U.S. capital markets for the sub-$500 million universe, which includes mainly deals off the shelf, excluding ATMs and IPOs. And during that time period, again, 1,900 transactions. 86.2% of the capital from a transaction point of view is coming from the sub-500 million market cap sector. But there's a transition from the actual dollar amount. Only 46% of the capital that's being raised is from the lower middle markets of the sub-500 million market cap, which basically is telling you is larger size companies are doing fewer deals but are raising a lot more dollars when they're coming out to raise capital in the public markets.
And how is the public market for the sub-500 million emerging growth companies, how has that changed, and what are some of the trends that you see?
Well, you know, trend-wise, you know, on average over the last 5 years, the average discount that the sub-500 million market cap company that's doing a deal is they're selling at roughly a 16% discount. But across the board, no matter the sector, 50% of every deal that is coming into the market in the lower middle market has some form of warrant coverage. Again, 50% of every issuer, whether it's a healthcare business, whether it's a biotech business, whether it's a TMT company, issuers are using warrants to go and raise capital. In particular, though, is if you look at over the 5-year period, the percentage of warrant coverage over that time period is really predicated on where we are in the investment cycle, and in particular where the equity markets are. So if you look through 2019 to 2021, which were very robust equity markets, the percentage of deals that had warrants were around 40%. And over the last 2 years, where it's been a less of a less strong market, you've basically seen roughly 70 to 65% over the last 2 years.
And how did the pricing discounts for these equity financings, how does it compare from the kind of sub 500 million companies to the larger ones? And what are the factors that affect that?
Well, if you look at kind of the pricing discounts for companies over this time, excuse me, for sub $500 million market cap companies, again, they're selling at about a 16% discount. The larger companies on average are selling right around a 9% discount. And I think a lot of that is driven by the stage of the company, probably also some of the technical trading dynamics of the company. So larger companies typically have a lot more liquidity, much more diversified float, which is going to enable an investor to potentially come in. Also, too, is a lot of the bigger companies may also have options that are out there. One of the things to note, though, is if you look at the sub $500 million market cap company, the pricing discounts that they're doing deals with or without warrant coverage are very similar. So what that is telling me is that, some companies that are smaller inside, there might be a bigger risk profile associated with them, i.e. something in their capital structure, not enough liquidity, or an enhancement from an investment point of view is going to be needed in order to get a transaction done.
Okay, that's helpful. So the warrants they seem like very common feature for this section of the market.
Again, 50% of the sub 500 million market cap company does use warrant coverage to finance their companies. And, I would say is if you look at kind of the universe of companies, sub 500 million, comparatively versus north of 500 million, again, 50%, and the companies that are greater than 500 million in market cap, roughly 9.5% of these companies are using warrants. And I would venture to say is that when you start going from 500 to a billion, probably most of those companies are the ones that are using some form of warrant coverage. When you start getting north of a billion, you very rarely see any type of warrant coverage within the market. The one thing to note, though, is if you do look at the warrant coverage percentage that's out there, it's very much correlated in the sub 500 million market cap range from a percentage of deals getting done to the smaller companies. So in the sub 50 million, about 65 to 70% are using warrants, and then it starts to stagger down from 41 from the 50 to 100 million, 100 to 250 million, 27%, and in the 250 to 500 million, roughly 16% are using warrant coverage. So again, it's a highly used tool to go out and raise equity financing within the market.
And how does it differ, market cap is a very broad generalization. Like, how does shipping compare to biotech, compared to other kind of emerging type of industries?
Pricings in general are very similar across the board. In each one of the sectors, you might see some, volatility that's occurring, within the sector. The one thing, though, Matt, that I do want to point out is, if I comparatively look at public market companies that are going to raise capital, excuse me, versus a private company that's sub 500 million raising capital, a lot of the public companies are using warrants, but I would ask you rhetorically, right? Private company, for the most part, when they're going to raise capital from a private equity or VC fund, is not doing it in the form of common equity. They're typically doing it in a preferred, and that preferred typically has some anti-dilution, ratchet feature, could have warrants, could have covenants that if you trip a covenant, you lose your position in the company. I would beg to differ that the ability to get public, potentially have some form of warrant coverage, which also gets you potentially some additional capital on the balance sheet, is actually a far better solution in many cases than going just the private market route because of the enhancement of the ability to come into the market very quickly to raise money.
Yeah, that's interesting. I mean, we actually see warrant coverage now even from lenders, so it actually isn't even just a feature of equity.
Yeah, again, I think the maritime sector as a whole, and I think this is back to your point earlier about some of the discussion last year. I don't think the maritime industry has been educated well enough of what's going on in the lower middle market, right? Back to your point, even on the lender side, in the credit markets. If you're going out to raise mezz debt, doesn't really make a difference what sector you're in. A lot of mezz deals have warrant coverage in it, and they're ranging anywhere from 10 to 20% warrant coverage on a debt deal. So let's be realistic of where the market is. For smaller companies, you typically need some additional inducement or enhancement for an equity investor to come in and invest in these businesses because there is a risk profile to them. They're typically earlier stage. They might have needs for more capital. Their size of business doesn't allow them to raise enough capital all the time. So that enhancement is what facilitates investors to come into deals quite often.
Yeah, I think another factor is that the public companies are typically valued or often valued below NAV. So a very common area of pushback when you're marketing a small deal is why would I buy this deal at par when I can buy a big liquid company at a discount to par, right?
Yeah, but I think it's even more than that. Like, if I look back and on some of how the deals are getting priced within the market, in the run-up over the last couple of years, we've probably priced the best deals ever done in the maritime industry. Some of those deals were done without warrants, and some of those deals were with warrants. So we priced a deal for a dry bulk company named Synergy at 2 times NAV without a warrant. And then there was a number of deals where we've probably raised hundreds of millions of dollars between 2 to 5 times above NAV. And I would ask the question rhetorically to the audience. If I can go out as a banker and raise money at substantial multiples above NAV, are you willing to do a deal with a warrant when you're selling steel value at 2 to 3, 4 times more than what the steel value is? I would take that trade all day long because I have the ability to go out and raise capital and do it in a very accretive manner from a market point of view.
And when you're doing these transactions, I mean, do you feel like the investors are looking at the fundamentals of the company, or are they looking at the security? Like, what is the profile of the
It really ranges. Like, lower middle market is very different and very dynamic. It's almost apples and oranges when you're comparing a multi-billion-dollar company that's stabilized. They're not showing as much growth. But irrespective of where you are in the sector and the public markets, the technical component, and what do I mean by the technical component? How much stock is trading on a daily basis? How diversified is the shareholder base? What's your mix between institutional and retail is a critical component for when companies are coming to access the market. Because if you have a stock that is not liquid, meaning it's not trading a lot of volume, and you're showing a very high valuation, it's probably an inflated valuation because someone could buy a little bit of stock and push up the stock price. The same way if they need to sell the stock, they're probably going to push down the stock price. So the way the trading patterns of these companies are occurring is a critical component for when companies are going to raise capital in the public markets.
Yeah, I think it's important to really provide clarity on how this market works. As I said, when we started, it's so many of the companies in our sector are small. So it's important to kind of lay out what the ground rules are or what's available in the market. We don't have much time, but for the owners that are here and kind of thinking about raising equity, is the market open? What advice do you have for them? What can they expect?
Yeah.
Are you doing deals today? I saw an announcement of a transaction the other day. What's going on?
We're very active in the market. Again, we're across the board, not just from shipping point of view. So we've done roughly 70 to 75 transactions across the board. Shipping market is a little more challenging today because of the pricing differential that you're talking about. If you believe your company is worth NAV or slightly higher than NAV and the public comps are trading at a discount to NAV, you're probably going to have to come out at a discount to NAV. Now, there's other ways to access the public markets versus just a traditional IPO. We just announced a large reverse merger within the last week or two. On the first day of trading of that deal, it traded about $150 to $200 million of liquidity. That's unique in the reverse merger world. So sometimes people are trying to get public to have liquidity profile. We're also doing a small IPO that'll probably be priced in the market next week. We are covered on the book, which is great.
A shipping transaction?
Shipping. It's a one-asset vessel deal that we're taking out, and we believe there's a lot of growth that potentially can come from that. Now, these are novel ways to access the public markets, and when you're in challenging markets, you have to look at novel approaches. Money flows don't stop. Companies need to grow. And as a capital provider and as a banker that gives advice to companies, we are finding solutions that meet a company's needs irrespective of the market cycle. That is my job, is to match buyers and sellers and find a solution for a company to access the public markets or sell their business.
And you feel there's investor appetite for these kinds of creative
I,
structures?
I wouldn't say what it was 2 or 3 years ago when we were doing $100 million deals at a clip. It's a much more challenging market. You know, the facts that what I pointed to before is warrant coverage today in the current market is a little bit higher than we were 2 or 3 years ago. But the lower middle market, sub 500 million market, is still a very robust market. Again, as I just wanted to reiterate to the market, across the sectors, virtually every company, 50% on average, are raising capital with warrants in the sub 500 million market cap universe.
That's great. Well, Larry, I really want to thank you for coming today and doing the work and presenting some data. Clearly, this is it's an important sector of the market, and I really appreciate your taking the time to come back with us. Okay?
We appreciate it. Thank you.
Thank you very much, everyone.